Hi, I'm Steve LaFrance with Blakely Financial, and I hope your new year is off to a great start. Today we'll recap 2023 and provide a brief outlook for 2024. Our newsletter will provide a more detailed report, so be sure to check that out too. Markets underwent a sizable shift in the fourth quarter, mostly due to reversal in Treasury yields after spiking in Q3, inflation easing to its lowest level since 2021, and the Fed holding rates flat while hinting at cuts in 24. The S&P gained 11.6% during the last quarter, representing nearly half of the year's 26% gain. Bonds also had their best quarter since 1989, producing returns in the 7 to 10% range to help finish the year in the positive. Data shows that inflation continued to drop, even as the economy continued to exceed expectations. Headline inflation now sits at 3.1%, off its 2022 peak of 9.1%, and GDP has continued to grow for 5 consecutive quarters, reaching 4.9% in Q3. Still no signs of recession, but some won't stop calling for it. Some questions throughout 2023 was whether the economy could withstand the effects of the Fed's higher rates aimed at cooling inflation and reducing demand, ever-increasing geopolitical tensions, and multiple U.S. regional bank failures. The cost of capital was rapidly increasing. Shipping rates were falling as freight demand declined and supply chains normalized. Housing sales and construction remained weak, although national home prices hit a new record high as factors such as remote work and rising wages continue to boost demand. Higher mortgage rates are certainly a factor for decreased sales, but so are supply shortages left over from the pandemic. While portions of the economy slowed in 2023, the broader economy displayed remarkable resilience, with 10 out of the 11 sectors finishing the year with positive returns, and unemployment remaining near record lows at 3.7%. After adjusting for inflation, this chart shows how U.S. real disposable income continues to climb since the pandemic. Investor optimism is also on the rise as price pressures ease and expectations for rate cuts increase. Futures are currently forecasting 6 cuts next year, with the first as early as March, which is a big change from Q3 when there was concern that the Fed would need to keep raising rates. All of this is reflected in the fact that each of the major indices are now trading near all-time highs. So what's next? What should we be watching for in 24? The economy is growing at a solid pace. Labor markets remain tight. Inflation is decelerating. Housing is showing signs of rebound, which is sure to accelerate if and when rates begin to decrease. If there's one theme I continue to see with many analysts, it's that today's economy is very different from our pre-pandemic economy. You see it with remote work, extended weekend trips that incorporate work, online shopping, groceries and meal deliveries, etc. Spending is up in the categories of services and experiences, and that's not likely to change anytime soon. And what about the election? It will surely dominate the headlines this year, which will tend to be more noise than anything of substance. Elections create uncertainty and volatility because markets don't like unknowns, but history shows economic growth and corporate earnings ultimately drive the markets, not politics. Our focus over the coming months will be on the growing list of non-political themes such as rate cuts and post-pandemic changes impacting our economy. That's all for now. Take care of yourselves, and thanks again for your trust and confidence.